Good evening, everyone. My name is Lydia Creasy with Lydia's Home Team, and I'm here tonight. We are going to be talking about insurance and all the ins and outs of insurance as it relates to current homeowners and prospective homeowners as well. I'm here tonight with Silk Mettam, who is going to be discussing all things insurance with us. And then also Sherry Brown, my partner, and Jim Dixon, my partner as well, who will be helping with this discussion. So welcome and thank you so much for being a part of our webinar tonight. And we hope that you find it super helpful. If you have questions along the way, please feel free to drop them in the chat box and we will kind of power through the presentation and then go through any questions at the end. So just to start off this discussion, the reason that we're kind of bringing this to you guys is about last fall, Colorado got rated the third worst state in the United States for insurance. And there are some reasons behind that, and Sherry's going to go through those here in just a second. But we want to bring this information to you because it does affect current homeowners. What we are seeing is certain homeowners are getting dropped from their insurance. They may not be able to afford their insurance any longer, and or they may find themselves needing to move to get into an area where the insurance rates are not quite as high. We are specifically seeing a lot of issues with condos, townhomes, anything within an HOA, because if there was a master policy, insurance policy in place for that community, they've increased insurance rates, and a lot of times the HOA itself doesn't have the money to cover that increase. And so they are looking to special assessments or looking to the homeowners to make up that difference. So insurance has always been a huge point of our due diligence when we go under contract on a property. But now even more so, we are seeing this to be one of the most important due diligence items. And so we want to make sure that we're walking through that with you guys. And then also, even if you're just planning to stay put, there's plenty of reasons and need to kind of understand this insurance on a deeper level. So I'm going to hand everything off to Sherry. She's going to kind of chat through our outline for tonight, and we'll get started.
Thanks, Lydia. So the one thing that, as we've all said, Colorado's market is changing. The third highest behind, I think, California and Florida. And we wouldn't necessarily think that that's the case, but weather has changed here dramatically. Whereas, you may have a tornado or a hurricane, and that might not be a yearly thing. Here we have hail and wind, which has become kind of a yearly thing. So that's part of our Colorado changing market. So things have changed. Housing prices have also gone up, which are affecting our insurance costs as far as the rebuilding costs. It didn't used to be that it would cost possibly more to actually rebuild your home than would be to sell your home. So there are a lot of reasons. Whoopsie, there's my dog. That we're going through this tonight. So Colorado changing market. We're going to talk a little bit about insurability and homes that are insurable and what that looks like these days. We're talking about the flood and wildfire protection. We're going to talk about some cost saving strategies, whether it's within just how you're making your policy through the savings there that can be bundling or anything like that we'll talk about, or if there's things that you can do around the house that might save you some costs as well. Jim's going to talk a little bit about the claims process, and Silk's going to come back to things that actually should be in your policy, essentials. And then we're also going to chat real quickly about deciding on a company. I mean, you have so many choices out there. Just an FYI, you've got a Farmers, you've got State Farm, you have Allstate, you have all sorts of different companies. Silk is a broker, and so she works with several different companies and can shop those policies for you. Whereas a State Farm or any of the bigger companies, you are going to call them, and that will be the company that you're going to get a quote from. So that's what we're going to be chatting about tonight. So we're going to try to, like I said, power through this because there is a lot to go over. And we're going to try to keep it as concise as we can. So part of that changing market, obviously for Colorado, was COVID and the increase of materials and labor. Everything went up. We've had inflation. We can all have our conversations about why that is. But since 2020, 2021, we had some serious supply chain issues and the increased costs of materials. So that's part of it, labor also. The Marshall Fire and how that played into it. It was the number one, the highest in history catastrophic event that Colorado's ever seen from a cost standpoint. So that's the big reason for our market changes. And then climate change. We are starting to see an increase in storms and storms that are causing damage to homes. So those are all the reasons why you're starting to see it. I mean, for me personally, I've been working with Silk for the last few weeks trying to get my costs down because mine took my home cost went up significantly. So yeah, that's why we felt like this was an important thing to bring tonight. All right, I'm going to pass it off to Silk so she can really kind of hone in on really what changed in our insurance market.
Thanks, Sherry. My name's Silk Mettam, and I'm with Colorado Insurance. And like Sherry touched on, I am an independent agent. I've been working in the independent market since 2014 about, and this is probably the worst year I've seen in insurance so far. So she touched on the reasons why, mainly COVID, the cost of labor, materials increasing. Specifically in Colorado, we've had hail, fire, wind, and now tornadoes, which aren't typical, especially near the mountains, but that just became something last summer here in Highlands Ranch. So what that did is the insurance companies in Colorado, they had to look at their loss ratios, and what they are starting to do is bringing on any new clients. What that means for us is that our rates increase. There's nothing we can do about it. We can't really reshop. So we're just kind of pigeonholed into the carrier that we've been insured with because we can't move to another company. So some of these companies that have stalled bringing on new business, in my experience with the carriers that I'm working with, are companies like Nationwide. Safeco has stalled bringing on some new business where I used to be able to get quotes. They've declined. Progressive, they have a company called American Strategic. They've really halted bringing on new clients. They've changed their underwriting guidelines. And then on top of that, the insurance companies that will bring on new business, they've made insuring almost impossible. So they've tightened underwriting guidelines. You now have to take photos. Sometimes they make you do fire mitigation. And then they also will require that you bundle. So if you want to insure your home, they'll want you to also insure your auto to make the risk in their eyes more, I don't know, probably the right word, but I would say their loss ratio is a little more even, right? So that's kind of where we are in Colorado, just harder to insure. The prices have increased. And as Sherry and I have been working on her own policies, she'll see sometimes, and I'll touch on this later through some of the slides, it's assuming more of the risk to try and bring down that rate. All right, so some of the things that insurance companies look at is the insurability on the risk. And the risk would be your home. Some factors that they are looking at is how old is the home? Because I'm an independent agent, I have different underwriting guidelines for each company, and some companies are more lenient on older homes, where some only want homes that are new. But when you're out looking, let's say you're in the market to buy a new home, you kind of want to look at, is the home up to code? Did you look at the pipes? Are they still galvanized, or have they been updated to PVC or copper? No longer does it have a fuse box. Hopefully it has a circuit breaker box. All of these things will determine whether or not the home is insurable by a standard insurance company. Some of the more common claims that are coming up lately are sewer line and water backup. Getting your sewer line scoped is before you make a purchase is, I think, a smart move, because the old pipes they can start to build up, tree roots can grow through, and then all of a sudden you have a $12,000 excavation bill. And then another big item that I can get in more detail with is the clue report. So the clue report is going to tell you any claims on that risk. And you really want to make sure if you're buying a property that the clue report matches the seller's disclosure. So if on the clue it shows a $10,000 water claim, did the sellers indicate that there was a water claim on the seller's disclosure? Does that match? So those are some important factors to look at. The age of the home, things up to code. What details matter on the homes? The biggest factor here in Colorado is the roof. And the reason being is because we get so much hail. Not only do we get hail, but we also have, we're at high altitude. That sun is beating down on these roofs, and so they start to deteriorate. What's starting to happen through just talking to some of the insurance companies is that they may even go to not insuring roofs for full value anymore. So it's kind of like when you insure your car is not, your tires are not insured because those see the wear and tear. The roof is essentially like your tires on a car. I'm kind of surprised that insurance companies still insure roofs for full value. But this is why the deductibles have changed. So some things to look at are how old is the roof? Any roofs that are more than about 10 years old will no longer be insured at full value anymore in Colorado. What type of roof is it? We do not do wood shake shingles anymore in Colorado. Sometimes back in the day, they did tiering on the roofs where they'd have layers. That's an uninsurable roof. And some of the better roofs here in Colorado are the concrete tile or the ceramic tile roofs, or what's called a class 4 architectural shingle. Picture here, that one looks like an architectural shingle where it's not just completely flat. And those are typically more wind resistant, and they'll give you a better rate with some of the carriers. A lot of times I hear clients tell me that they got a roof certificate from a roofer. What a roof certificate is it can be some peace of mind, but essentially what it is it's a roofer comes out, looks at the roof and says, this roof looks in great condition right now, but tomorrow some rain can come, hail can come. They are certifying that roof as of that date and time. So as far as not having to pay out of pocket down the road, it's not going to help them in any way, but it does give people peace of mind that, hey, the roof was in good condition. When we purchased the home, it looked like it was in great condition. So some other factors that determine insurability would be where the home is located. And this one is becoming more and more important. So in Colorado, not only do we have hailstorms, probably 5 to 10 times out of the year, we get fire. Every summer there's a fire, whether it's just man-made or like the Marshall fires, which is a freak accident, but there is going to be a fire somewhere in Colorado at some point. So if the home is in a fire zone, I kind of skipped down to brush fire or fire line score. You need to make sure to pull, if you're showing a home in the mountains or you're looking to buy a home in the mountains, sometimes those homes are not insurable because the fire line or brush fire score is too high. It goes from 1 to 10, and anything in that 10 range is going to be really hard to find insurance in the standard market. The brush fire score is how densely populated the home is to tree and shrubs. So sometimes the carrier would be willing to bring on the risk, but you would have to get a professional fire mitigation company to come out to make sure that it's properly mitigated for fire. Another factor would be, is the property in a flood zone? This one is not very common in Colorado. We do have flood zones. Flood insurance can be kind of pricey if you're in a flood zone, but that is a completely separate policy from your standard homeowners insurance or HO3 policy, and that is regulated by FEMA. So you can't really shop flood insurance. The rate is what it is. It's just either you have to have it or you don't. If you do need flood insurance, that's because you're in a flood zone. Depending on that zone, it's going to add, I'm going to guess thousands to your premium each year because it's a totally separate policy that has to be built into the loan. And then high value homes. These are becoming harder to insure as well because we don't have a lot of carriers that will give us binding authority in Colorado above a certain reconstruction cost or price point. Most of the companies, the high value starts at about 1.2 million. And so anything above that, you would have to go to Chubb or Cure. Those are some of the companies that specialize in higher value homes. So this is an interesting fact is where Boulder, Lafayette, and that Broomfield area used to be in a fire zone for protection class 1 or 2. I just ran someone's insurance in those areas and it moved to a 4, which then makes your premiums go up. So the higher your protection class, the higher your premiums. I'm assuming the reason why they moved that PC class up is because of the fires from the Marshall fires. They decided, hey, this fire happened, the response time where we thought it should have been in a PC zone 1 or 2, that did not add up. So they moved that PC class up to a 4. And like I said, so then your premium will increase because of that higher PC class.
What does the
All
P
right.
stand for, Silk?
Protection class. So a PC class is how the fire department determines how accessible your home is if your home was to catch on fire. How close are you to a fire hydrant? Do they have to bring water up to you? Can you, is your home, are you able to see your home from other people's houses? And no one can change the PC class except for the fire department. So let's say you said, you know what, I fireproofed my house. I put a fire hydrant right in front. I think my house should be in a PC class 1. We can't change it. It's how the fire department determines it. And that's kind of your address is put in there and then that's what they decide. Some people think that they're in a low protection class, but then they don't realize that their home is not monitored by a fully manned fire department. And they'll say, oh, well, there's a fire department 3 minutes away. Well, it's a volunteer and there's people there maybe 2 days out of the week. So go ahead.
What is the difference? I mean, is a wildfire and just let's say your house just caught on fire. Is that considered a wildfire? Is any fire a wildfire or is it different?
That's a good question. So there's the PC class is specific to a wildfire. So a wildfire is just your brush fire. So how susceptible is your home to catch on fire because of the brush, right?
Mm-hmm.
And then from there, the PC class is determining how quickly can the fire department put that fire out. So it's how quickly is your house going to catch on fire, and the PC class is how quickly can the fire department put out the fire.
Mm-hmm.
So some of these homes, like in Evergreen and Conifer, here's another thing to consider. There's only one lane that goes up to their house. Let's say you're trying to evacuate, right? Fire truck is trying to come up to you. What do we do now? You guys are now at a standstill. There's one small road that goes up, goes down. That would make your PC class pretty high, right? Be hard to get that fire out. Even if you properly mitigated and your brush fire score was low, your PC class is high. So it kind of puts you in a bad situation.
Got it. Okay.
That's so interesting because you see fire stations like all the time. I guess I never even thought about like how much they're manned.
So the insurability of the homeowner. I had a client that called me and she wanted to know if she should file a claim for smoke damage because her neighbor's house caught on fire. Anytime you call your insurance company, you have a claims adjuster come out, they assess the damage, and you open a claim and there's a claim number assigned to you, that's going to show on the clue report, what I mentioned earlier, Carfax kind of for your home. That claim number will show. Whether or not they paid anything out or not, it'll still show a claim. Now you're probably going to ask, why does that matter? Well, let's say you keep calling the insurance company over every little thing. That tells the insurance company, is this person trying to file claims that are being declined, or is this person truly needing these claims to be paid out, right? Or are they not getting paid out and then the damage not being fixed? So there's three concerns here. So if the homeowner continues to file claims, and from a real estate standpoint, let's say you have a client that's filed 3 claims on their previous property. They don't think that's a problem, but when they go to get insurance on their new home, those claims still follow them. They don't drop off just because they sold the home. We can still see those claims showing up on their CLUE report. So what type of claims matter? The ones that really affect you are the ones that show, I guess, some negligence, I guess, would be, for lack of better words. I don't know. Catastrophic claims aren't going to affect you as much. As far as insurability, it will affect still the rates, but insurability, not so much. Theft would be one of those that affect you, because in a sense, even though you feel like you're the innocent party here, there is some area, I think, of negligence. If you left your garage open, your bike was stolen, or things like that. Liability claims would be an area where they would surcharge or it would be harder for you to get insurance secured if you have liability claims. Physical damage claims. Your umbrella on your patio flies into the neighbor's yard, or your trampoline that wasn't tied down securely or wasn't properly installed in your backyard goes and flies through your neighbor's window or your window, right? Physical damage claims would be surcharged heavier than a catastrophic claim. Is the homeowner going to be able to secure a policy? So back 2 years ago, 3 claims wouldn't be a problem. Now, most companies will not take any homeowner that's filed more than 1 claim in 3 years.
I was going to say, so that follows you. So if you were to move, the claims from your previous house follow you to the new house.
Yes.
Aha.
Here, that's a really good question, Sherry. So actually, your claim, let's say you have rental properties, okay? Let's say you file a claim on a rental property and then you have a primary home.
Mm-hmm.
And then you sell that rental home. That rental home was being surcharged for that claim, but because you sold it, that claim now moves with you to that primary. If you were to move to another company.
Mm-hmm.
Does that make sense? So that claim still follows you, even though you sold that home. And then you also want to try and keep all your homes insured with the same company, because if you have them with 3 different carriers, rental homes, primary home, they each have to surcharge separately for that claim. But a company can only surcharge one time, put it on that specific risk, that claim. Am I making sense? Am I explaining that?
Yeah, that makes sense.
Okay. So
how long is that one claim hang out for? Like, is that a 3-year or 5-year or?
good question. Typically 7. You'll see that on the CLUE report, but some companies surcharge. So there's things that it's called a look back period, and then there's a surchargeable period. Some companies will look back 7 years, some will look back 5 years, and this goes with auto insurance as well. And some will look back 3. Nationwide, I loved Nationwide for so long until they stopped bringing on new business, but they would only look back 3 years, which made it so much easier to get insurance secured, because if someone had filed a claim, right, I could still put them with Nationwide. So I would say the magic number is 7 years in general, but each company is a little bit different. Mm-hmm. Is the homeowner's debt to income ratio or credit score important? Yes. And when I run quotes, I will pull insurance score. It's not a hard hit to their credit, but it does look at the same things as credit would look at. It'll look at your, you know, how timely you are at paying things, how timely you are at paying insurance, how many claims you filed. And some carriers, again, because I don't have one specific set of underwriting guidelines, some carriers will look more heavily at one thing than another company. The biggest way to save, I think, is to bundle the home and auto. Every company, captive, independent, whatever, they're gonna give you a huge discount by bundling home and auto. I'm thinking a couple reasons why, because I keep saying that these insurance companies don't want to bring on new business. So you're like, well, why not just have the home? You know, if someone wants to insure the home, I really believe it has to do with their loss ratios. If there's a claim on the auto, they're still getting the premium on the home. The new roof is in Colorado. That one's going to be a huge discount as well. It will drop hundreds and hundreds, at least 15 to 20% if you put a new roof on the home. And like I said, the most of the carriers aren't even wanting to take your house if the roof is more than 10 years old. Class 4 shingle is a type of shingle that's hail resistant. If the roof has a class 4 shingle, you can get a certificate. It's not a warranty, okay, like a roof warranty, but it's an actual class 4 roof cert. And you can get that from the roofer that put the roof on, and that'll bring your premium down probably another 10%. And then the ceramic tile, I have 3 companies that love ceramic tiles roofs, and they will give a significant discount for having that type of roof. It's just wind and hail resistant as well. But another big way to bring down your premium is to assume more of the risk. So let's say you just put on a new roof, right? No need to have a low wind hail deductible if you have a brand new roof, right? You could increase your deductible and that would drop your premium probably a new roof and a higher deductible for wind and hail would cut your premium more than in half. The average deductible, I would say, for wind and hail right now is 1% of your dwelling. If you were to up that to 10, 15,000, which is like self-insuring your roof, that would bring your premium down. But the only way I think that would be smart to do is if you had a brand new roof on your home. Anything, like I said, older than like 5 years, you would really want to be careful about making those types of changes because you would be self-insuring then essentially. And I have a ton of clients that have been reaching out to me because their premiums increased. And then I go and I look at their deductibles and they have a $2,500 deductible. And the biggest thing I tell them is, hey, I can save you some money, but you have to be okay increasing your deductible before hail season. That's something to really consider. I mean, we don't just get one hailstorm in Colorado, we get like 5 a year.
So just to kind of interject here a little bit of why we're here, if you're a home buyer and you are looking at homes, what used to be kind of everyone can get home insurance. We knew about what the price was. We knew where we could, lenders would know exactly, how much it was going to cost based on the price of the home. They had a general feel for it. That has gone out the window. So it has become a much more important piece of our due diligence when we're helping somebody buy a home. If we've got someone that is really on a tight budget, we really need to watch this. In the past, we used to have, a pretty quick turnaround on being able to say, yeah, I can get insurance for the house. Now we're putting it out really a couple of weeks out so that the home buyer has some time to make sure that, one, they can get insurance for the home, and two, they can afford the insurance for the home. We're definitely taking a little bit more of a strong posture, so to speak, with our home buyers on the insurance. What we are looking at is, did the prior owner file claims? So as Silk mentioned, there is a clue report, and there's actually a slide coming up that is going to talk a little bit about it, but it's pretty simple. It actually goes back kind of like a Carfax, and it tells us what claims have been out there. It'll tell us what they were for, if it was fire, if it was wind, if it was hail. It'll tell us the type. It will tell us how much that insurance company paid off. And those are the types of things that we want to make sure if there was a new roof put on and hail damage, we want to be able to see that in the property disclosure. We're going to be asking the seller. If you have a basement in the new home, was it a permitted basement? If it's been there a while, it may not have had permits pulled. So those are things that we want to make sure we know when you are doing your due diligence on a home. And a lot of this will kick back to insurance. We want to make sure we know the answers to all these questions as we are going through our due diligence within a transaction for a new home, which is for sellers. Let's get that information up front, disclose as much of it as you can, because it is illegal to not disclose something in Colorado that is a material fact of your house that you know.
So Sherry, just to interject, and maybe this is more of a question for Silk, but I have definitely been running into that a lot with listings as far as the roof being more than 10 years old. So is that as of now a hard and fast rule? Because what I've been seeing is that it's kind of subjective. When will that become a hard and fast rule?
The roof, it's
The
not.
10-year, yeah.
It's not. So
Okay.
I gave you a general
Okay.
kind of a general
Seems like it
time
varies
frame.
case to case.
Well, no, it's not case to case. It'll be carrier to carrier. So for instance, I can tell you the companies that won't insure for full value after Travelers, 10 years, you're not gonna get a rate. Or Safeco, not anymore. Um, ASI, no longer. Nationwide, no longer. That's just kind of a general rule of thumb, 10 years, but we can still get a policy in place. So it's not a steadfast rule. So I mean, you could find a company that will still insure it. The premium will reflect an old roof. I mean, it'll probably be double, but you can get insurance secured.
All right. So just to talk a little bit about claims, I know Silk covered a big bulk of everything here. But when it comes to whatever your damage is, whatever your claim needs to be, like she said, with multiple claims, we had a client who had a small water claim within the last 3 years, and then they had a larger water claim come up where a dishwasher leaked. And after filing that second water claim within 3 years, the insurance company said you're no longer insured as of whatever date. So the client had to go and shop for insurance, and that's a really hard thing to do when you have two water claims within 3 years of each other. So looking back, was it worth making that claim? Because they had to go to a different insurance carrier, and the insurance, the amount that they're paying for their premium now more than doubled to get it insured. And then with that, it's a different type of insurance company. It's not your normal ones that are the most used, so they're not the most affordable ones. And then that changed some other things, like it says your house isn't covered by wildfires, which luckily it's in the middle of a subdivision and the risk of wildfires is rare. But the way they define a wildfire is very interesting in there. So a lot of weird things that can come up when a policy gets canceled like that. So it's worth it to get some quotes before making that call to the insurance company. If it's not something that's destroying your house in the process and you need, some restoration company to come out right away and make it all stop. So we're always here to answer those questions for you if you ever have a question, if you should file a claim or not. And same with.
Just like quick question on that, because I had this recently, but usually, I mean, in my most recent case, like my client wasn't sure whether they wanted to do a claim because it was going to be a smaller claim. Like there's no penalty for somebody calling their insurance company, talking to them and seeing whether or not they should make a claim. And I'm not talking about like calling the 1-800 number, but their local agent. Like, do you see any issues with that?
No, and that's just what happened to me today. A client called me about her neighbor's house going up in flames and then the smoke damage to her house if she should file a claim. The only time it's going to affect you, like I mentioned before, is if they open a claim. You need to say, is there a claim number associated with this call, right? And if there is, that now is an open claim. Okay. But if you just call your agent that State Farm or me or whatever company you're insured with, and you say, hey, I'm not opening a claim, but I have a general question, that's that's definitely advised. Yeah. Just so you know, it's called hazard or catastrophic insurance for a reason, and it's to cover catastrophic events. Not some people will use it for like, oh, I need to repair my fence. It looks like it's falling over from the wind. That's just normal home maintenance.
So yeah, that's a thing to weigh if you should file the claim or not. So what happens if the insurance denies your claim? I have a client right now who we had their house listed. We like to get ahead of things sometimes. So when we go to list a house, a lot of times we recommend for them to get the roof inspected and make sure it's in good order so there's no surprises at inspection time. And this roof definitely needed replacement. He filed a claim with his insurance. There was plenty of hail damage on there, but the insurance company said they couldn't trace back a storm in that area within the last year, so they denied his claim. So he chose to go hire a public adjuster, which that, you call your insurance, they have their adjuster come out. A public adjuster is somebody who's working for you rather than working for the insurance company. The public adjuster came out, did his inspection, contacted the insurance company, and it looks like the insurance company is going to handle the claim. We're just waiting on that to become 100% yes, which we should know in the coming days. So there are ways around just hearing the no. It's also worth it if you have a contractor come out, a roofing contractor or whatever the issue is, and having them contact the insurance company too, because they have a lot of expertise with that. They deal with insurance companies all the time, and they can call them and give all the stats and facts and figures of exactly what's wrong with the roof or whatever it is, and sometimes get them to cover a claim that they've already said that they're not going to cover. And that also goes into this next point here of, is insurance reimbursing the correct amount? When you file a claim and the insurance company says, yes, we'll pay for this, they give you a whole breakdown of all the numbers for each line item that needs to be taken care of. So if it's water damage claim inside the house, that'll include any drywall that was damaged, flooring that was damaged, anything like that. And they have amounts for everything on there. If the amount's not correct, you probably won't know that as the homeowner, but once you hire a contractor and they come in, they'll say this is high, or I'm sorry, they'll say this is low. They'll never say this is high. And then they can work with the insurance company to get those numbers adjusted. It's kind of hard for just the average homeowner to argue those numbers with the insurance company, but the contractors do that on a regular basis as they're fixing these problems that arise. And then along with that as well, there's also the depreciation amount. So Silk can probably cover a little bit difference or explain a little bit better the difference between an actual cash value policy and then the replacement cost value. Either way, when it shows the depreciation on there, it'll say, let's say you need some wood floors replaced and those floors have been down in your house for 10 years. And the insurance company says the life of the floors is 20 years. So they'll give you 50% of the replacement costs. Now, once you get the floors replaced or you have a contract to get the work done, they'll give you the rest of that cost, but just up front, they're not going to provide that amount because I think a lot of people don't get that work done and they just collect the check from the insurance company. Is that accurate?
Yes, you're spot on. You're explaining it exactly correct.
Good. Very good. So yeah, there's a lot that goes into a claim. Unfortunately, we see it a lot in trying to help our clients. So it's a good thing that we're able to help walk them through that. It's never a fun process to go through. It's never a simple process to go through. So if you ever have any questions or need any advice with that, let us know. We can point you in the right direction or connect you with the right person for the right advice for the given situation.
Sorry, just to touch a little bit more on what Jim was saying about, is the insurance company paying out the right amount? One thing you really need to consider too is deductible. So where you think that they didn't pay you, you have to also remember you might have a $10,000 deductible, and that's where that gap in coverage is, right? So that's also something you have to really consider. This has come up, I would say, so much since January for me. Really look at your deductible and don't think your insurance company isn't paying. You need to remember that gets paid first. Policy essentials. There's different types of policies. There's a policy for a standard single family dwelling, which needs exterior coverage as well as the roof. There's something called an HO6 policy, and those are set aside for condominiums or townhomes. I know in real estate and lending, condominiums and townhomes are totally different because of I don't know what it is, but in insurance, the only thing we're concerned with when it comes to an HO3 or an HO6 is not is the exterior covered by a master policy home HOA insurance policy. If it is, that would be an HO6. And if it's not, and it's a single family detached dwelling, that would be an HO3 or HO5 policy. Okay, those now some important things on both of those policies would be, well, assessment coverage would be important on an HO6 policy. Assessment would be any assessments that the master homeowners policy, the master HOA policy assesses each homeowner to cover the master policy deductible. Okay, and this is where it gets confusing, is because it's not going to cover your monthly assessments. It's only going to cover if they had to file a claim and they had to use their deductible. That's when that assessment coverage would kick in. You need to make sure that you're covering enough on your policy assessment to cover the master policy deductible. Okay. Typically nowadays I'm gonna guess it's between $10,000 to $15,000 of coverage. So that's an important piece to an HO6 policy. Even some HO3s will have a community pool or community maintenance that you'll still want some assessment coverage for. Water, sewer, sump pump, and backup coverage. Now this is totally different than flood. So flood is groundwater coming into your home. Water, sewer, sump pump, backup coverage is literally the sewer backing up, the sump pump backing up into your home. So I always ask your clients or any clients, I say, do you have a sump pump in the home? And if they do that, I will put that coverage on no matter what, because that will cover that sump pump malfunctioning. Service line coverage is going to cover your service lines, whether it be electrical, pipes, anything from your home to the street. So this is where it gets sticky. It's nothing underneath your house. So if you have a crawl space, if you have anything like that, and it's underneath your home and your sewer line was to break under there, they're not going to cover. This sounds so silly, but anything underneath your home, but anything from your house to the street, they'll excavate and replace that pipe. Replacement cost versus actual cash value. Replacement cost is what you want. That's going to fully replace your home, your roof, your floors, your personal property to current value. Just like Jim said, they're going to pay you to start the process. And then once you replace it, you show them the receipt of however much you spent. They will then cut you the check for the remaining portion of that, if you endorsed it correctly, if you had a replacement cost policy. Now, if you had an actual cash value policy, they would only cut you that first check to get you going, and then they'd leave you on your own, right? So this is really important on roofs. What I've been noticing when people send me their policies to reshop, I'll look and I'll say ACV under wind and hail. And that means that they're going to get the actual cash value of their roof. So if your roof's 10 years old, essentially, if you have a $2,500 deductible, you're going to get paid nothing, right? Because your roof's not worth anything. And then you pay out the $2,500. So you might as well just buy the roof yourself. Reasonable deductibles. This one is a little bit different than what I would have talked about a couple years ago. What's reasonable now was not reasonable 5 years ago. I used to quote nothing above $2,500 for wind and hail because I thought it was ridiculous to go above that. Now I can't find many insurance companies that won't mandate a percent deductible. And what that percent is, it's a percentage of your dwelling reconstruction cost. Okay. So if your dwelling reconstruction cost, and I don't remember if we put this slide in there. If your reconstruction cost, let's say, is $800,000 and you have a 1% deductible, that means your deductible would be $8,000. And each year your reconstruction cost increases whether or not you ask them to increase it or not. It's just because they automatically increase it to support the cost of materials and labor each year. State Farm, Farmers, USAA, auto owners have all gone to percent deductibles. State Farm, if you don't bundle your home and auto, I believe it's 1%. If you do, I think it's 0.5%. Farmers, in some areas, it's 2%. So I saw a client's policy the other day from Farmers, and they lived kind of in the mountains, and their policy was, or their deductible was $26,000. At that point, you might as well just self-insure. Oh, and their premium was over $8,000 a year. So these are reasonable deductibles. If you have a really low premium, but your deductible is a little bit higher, I would still consider that reasonable, right? You're saving yourself $2,000, $3,000 a year. You increase your deductible by assuming a little bit more of the risk, 2,000 to 3,000. I think that's a pretty good wash. So that's why I said reasonable, because it's hard to say what's a good deductible and what's not. It really is dependent on what your premium is, right? And if you're willing to assume more of the risk for a lower premium. So accurate RCEs. So the RCE, that stands for replacement cost estimator. This is a third party estimator. It's usually the one I use is called Marshall Swift Beck through CoreLogic. And I put in all the specs of the home. So I'll ask square footage, is the basement finished, what type of finishes you have. I put all of that into the cost estimator. And once I'm done, it spits out a number to me and it says, this is what we estimate the cost to replace your home, materials and labor. So the land is not accounted for in that estimate. The reason why is because the land will still be there. If there was a, fire, hurricane, whatever the case is, they just have to rebuild the structure. Some companies, they started going to the higher RCEs, inflating your reconstruction costs because they could not endorse enough to cover value of the home. Okay, so like let's say in downtown Denver, some of these homes, 2-bedroom, 2-bath, maybe 1,200 square feet, and the home downtown might cost $1 million. There's no way we can get the reconstruction cost estimate to cover, let's say, the loan of $800,000. So what they started to do is inflate that. Well, that is how your premium is built. If you inflate your reconstruction cost, it's going to inflate your premium. You want that to be as accurate as possible, and then you want to endorse your policy for what's called extended dwelling coverage. Most companies will go 20%, some will do 25%, some will do guaranteed replacement coverage, and or 100% coverage, or some even do 50%. The carriers that I work with, all of them do 50% or more. I take that back. Allstate's the only one that won't go up to 50%. The highest they do is 40%. But most of my carriers will do 50% or more. And what that does is it keeps your actual dwelling at the correct reconstruction cost, but then you endorse it for that gap in coverage where cost of materials and labor go through the roof. For instance, like the Marshall fires, some people's, when they got their insurance, let's say it costs $500,000 to rebuild their home. Well, because of COVID, the cost of lumber increasing 4 times the amount, labor being the labor shortage, everything costs 6 to 7 times more, and they did not have enough coverage. So that is really important to make sure you have extended dwelling coverage and that you have an accurate RCE. Actually, when I was talking to Sherry, I think I was missing an entire bathroom or something on yours, and it made the reconstruction cost different. But then we went through it together and we decided, oh, we're missing this. And then we had to make some changes. But you want to go through that pretty thoroughly with your agent to make sure you have all the specs accounted for and that it's accurate, and then endorse it correctly. And then one other bullet point that I did not put on here, and I'm sorry, would be ordinance or law coverage. So, and loss of use. Ordinance or law brings your home up to code. So on these older homes, and in these Marshall fires even, some of the reason for that gap in coverage is because they didn't have that endorsement on there. So where they could build a home, right, to that amount, they weren't getting that up to code because they didn't endorse it. So there could be a gap of $40,000 because they have to bring it up to code. A good example would be like some of these older homes where they have the galvanized plumbing, or they still have aluminum wiring in the walls in some places. I mean, that can be $20,000 to redo all the wiring and bring it to copper. Copper is really expensive. So that ordinance or law coverage will bring your home to code. And then loss of use is super important. When the Marshall fires happened, I had a ton of clients reach out to me. It was not able to, they were homeless. They weren't able to live in their house. And the first thing I did is I was able to find all my clients in those zip codes, and I sent them an email. If you need to start using your loss of use, all of my clients carry 24 months. So that means if you have to live in a hotel, it's going to pay for the additional living expense of your hotel stay, or if you no longer have a refrigerator because you're in a hotel and you have to eat out now, the additional expense of that, extra mileage to work. So it's going to take care of the extras that you have to pay for not being able to live in your house. Unfortunately, it's not going to pay for the mortgage. That still has to be paid for you by you, but anything above and beyond what you're normally used to paying, that's where that loss of use kicks in. And you can go out, get your toothbrush. You know, these people were left with no clothes, no shoes, no nothing. And so that starts to kick in, and you can start using that immediately. There are some policies that will give you a dollar amount, which is fine, but in these catastrophic situations, I believe that the 24 months or actual loss sustained is really what you want to see on your policy. Because then, you know, you can go through a dollar amount really quickly, but the time is really, I think, where it's at, right? 2 years, I mean, go ahead.
I was going to say, which is important to remember, because you are still, your house might be gone, but you still have a mortgage on it that you're still paying.
Right. Well, and I mean, just think if you were involved in those fires, you had to evacuate. You didn't have extra clothes. I mean, you have to go out by all your necessities like that day, you know? So that's when that kicks in. What to look for when deciding on a company, captive or independent. So I'm going to be totally honest, really, with captive. The benefit of a captive company is their rates tend to stay more stable. And I'm just going to be honest, shooting my own self in the foot. But like State Farm, people who've been with State Farm, their rates typically don't increase a lot. They stay pretty consistent. Independent, your rates are going to change every year, and they can change a lot. And the reason why is because you're going to probably reshop and switch. Makes a lot more work for me because now everyone's rates increase each year and I have to find them a new company every single year, but it is what it is. But you're always going to have to reshop, but you will probably be able to find a consistent rate by switching. Captive, their rates typically stay pretty consistent. However, these past couple months, State Farm, Farmers US, all of these companies, their rates have increased significantly. The average rate increase in Colorado was 56.9%. So if that tells you, I mean, people call and they're upset that their rates literally doubled. Well, everyone's rates doubled. And then a captive market is exactly that. They're going to target a specific demographic. So for instance, USAA, who are they targeting? They're going to have every single person that's by any type of a military base, right? My opinion is you do not want to be insured with the exact same person every one of your neighbors is, because if there was a loss or a fire or a hailstorm, now every single one of you guys have to file a claim, and your rates, whether or not you like it or not, they're going to increase because that geographic area just got hit with hail and they insured everyone in that area. So USAA, they're targeting military. State Farm targets a certain market, farmers, and they only have one set of underwriting guidelines. So if they only take, for instance, State Farm will only take one claim. If you've had more than one claim, you can't get coverage. Independent is exactly that. We're independent. We can shop different companies. We have no specific allegiance to any of the carriers. We're just going to try and find the best fit, the best rate for you at the given time. It's not going to be like that forever. I could put you with Safeco this year, 3 years from now, their rates go up, 50%, and there's another company that's trying to capture the market. You'll just have to reshop and switch, but it does take time to do that. More so for me than you. I mean, all you have to do is say, hey, reshop, but um it yeah, I mean, that's the difference, is that the rates do fluctuate a little bit more.
As we've been talking about, the Marshall Fire was a big deal. I had a friend that lost her home in that, and she's also a lender. And so she just, after a little over 2 years, they just finally got back into her home. And I had to keep her anonymous because there is still some litigation and things going on. So she didn't want me to use her name. But at the end of the day, she said the biggest piece of advice is not to be stingy on your coverage. If the coverage is better and it's going to cost an extra couple thousand or a couple hundred, sorry, do it. She said fully covering your rebuild as opposed to the hundreds of thousands of dollars you may need to borrow on. That gap coverage that we talked about, that replacement value, so important. And she said, I never thought something like this could happen to us, and here we are. So never think it can't happen to you. Be careful. Just make sure that you've got good coverage. And if you have any questions, we're all here for you.
And we've got a few minutes left. I see some questions in here. So, Silk, one question is, should you document the contents of your home? And if so, are pictures okay for that? Is that beneficial?
Yes.
I actually heard after the Marshall fires, it's probably good to just do a whole video walkthrough every year.
Yep. Yeah. Yep. And anything that you have high value, jewelry, definitely get a separate policy for that. And even if you don't have a catastrophic situation, you lose your wedding band or whatever, it's a very small amount to cover something of high value.
Great.
Okay. And somebody also asked, what is builder's risk coverage?
So that's a separate policy. Builder's risk would be if you're doing extensive renovations on a home, breaking down walls, you're not living in the home, you would need a builder's risk.
Right. And a lot of people who
Separate.
do that's the type of policy they get, correct?
Yeah, so it's separate from a standard policy. Mm-hmm. It's hard to, I don't do those.
Oh,
Don't know a lot about them.
I know you can go through, I think Foremost is a pretty decent company from talking to some investor clients who get
Exactly. I do have Foremost.
those. Okay.
Mm-hmm.
Looks like everything else was answered. The question is, wind coverage included in most plans? We kind of touched on some of that.
The ones, yeah. I mean, I can't speak for every carrier, but I can speak for all my carriers. Yes, it is included.
I have two questions, and I know we're running super long, but how are you making sure as their insurance agent that they're being covered for like the true value of their home and not what it was 4 or 5 years ago? And how can we partner with you in that?
Well, that's a really good question. So, the policy reviews are recommended, but when I initially write people's policy, I never have written a policy with under 50%. So it's doubling your reconstruction costs. Yeah. Mm-hmm.
Okay.
I also let my clients know if they make any renovations, add bathrooms, they always have to let me know because I need to account for that in the cost estimator. But so there's three types of things that I look at in a client. Are you looking for price? Are you looking for protection? Are you looking for service? Pricing is what it is. I can't really do much there. I don't write a lot of substandard business. My clients typically understand the value of insurance. Just like Sherry's friend said, if you pay a couple $100 extra for insurance, the value's there.
And then second question is like, kind of takeaways from what you've discussed tonight, but like checklist for people who are listening tonight or listen to this later is, maybe if you are considering replacing your roof, maybe you do consider upgrading to that impact resistant. that you maybe, I mean, obviously everybody's going to just need to talk to you, but, you know, maybe consider, coverage for, you know, the sump pump or something along those lines. Just as kind of general precautions, and not also making sure that they're kind of, ensuring the full value of their home, and we can help with that too. But
I would be happy to just, if anyone even wanted to send me their policy to make sure, is this a replacement cost? Sometimes I can interpret other policies. Sometimes it's done in like code, like HS, you know, a whole bunch of coding, which I can't interpret, but um, it should say on every policy if it's ACV or replacement cost. I can tell you what your deductible is if you're having trouble finding it, if you want to download your declarations. But it is good, especially more so with our weather here in Colorado, to review your policies. Um, and then just to make sure you have the proper coverage, and then those cost saving things that people don't realize, like where if you're struggling to pay your homeowner's insurance and it's high, maybe bundle your auto with it if you didn't think to do that, right? Or if you just put on a new roof, increase that deductible and bring it down almost by, you know. And also you have to remember to tell your insurance company if you replaced your roof.
yeah, just
That's a
little,
huge,
yeah.
Yeah.
So yeah, maybe we can come up with a little checklist of things like on a yearly basis, because that, I mean, those are important things for everybody to think of, almost just like home maintenance, you know, just insurance maintenance. Well, I think you provided a lot of great information, so thank you so much. I know it was probably a lot of information. We'll try and divvy this up a little bit, but thank you so much for your time. And Silk's information is listed here in the slideshow. So if you guys are interested and want to kind of have a review of your policy, please feel free to reach out to her. We're here as well to answer any questions that we can, or just direct you in the right spot. Does anybody else have any ending thoughts?
or call even your own insurance agent and review your policy. Make sure that they, just like Lydia said, 4 years ago it's changed. So even, yeah, call your own insurance agent and review your policy, especially before summer. Make sure you don't have like a ridiculously high deductible. So, all right.
All right,
Thank you
thanks
guys.
so much. Have a good evening.